As we mentioned a bit earlier, energy shares weighed on the market today. It tends to be a sector that stocks follow pretty closely. And as Bob Pisani reports, it's not clear if the bulls are in control right now or the bears.
The markets may be at new highs, but one sector is showing signs of stress, and that's big oil. The broad market's been drifting higher since the beginning of the year, but oil stocks has been drifting lower. It's not a one-day affair, it's a trend. The evidence is everywhere. Chevron's at a new low for the year. ExxonMobil's down nearly 10%. The Oil and Gas Exploration and Production ETF, which is weighted towards U.S. producers, down 5% for the year. What's happening? A reasonable conclusion is that there's a valuation problem for energy stocks. The markets are still discounting a significantly higher price for oil, and a lot of people doubt that that's happening. How much higher? I don't know, but a lot of people at the end of last year were talking about oil in the 60s or even $70 in 2017. The oil bulls insist demand's improving. They say OPEC's agreement to cut production is holding, and all that's true. But look at the supply side. Traders have noted that more than 200 additional drilling rings have been added this year. U.S. production is back up to 9 million barrels a day. And oil, you know, it's $53. It's exactly where it was 2 years ago. That's right, oil was $53 on this day 2 years ago. It touched $60 briefly in June of 2015, hasn't come close since. What needs to happen? Well, in the short run, we certainly need to see inventory levels come down, and that doesn't look like it's going to happen either anytime soon. You can see why the energy bulls are having a tougher time of it recently. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.